Welcome to Index Orbit, where we make trading easy. In today's lesson, you will learn how to identify institutional footprints on a price chart and how to use them to find high-probability trade setups. We have three main objectives today. First, define and identify order blocks. Second, define and identify fair value gaps. And third, use open interest walls for confluence. Our goal is to move away from reacting to price after it has already moved, and instead, learn to trade the return to value. Before we dive in for live data of options and quick analysis, I recommend using the Dhan trading platform. Use referral code EJZZI96380 for the best trading experience. And don't forget to like and subscribe to Index Orbit for our latest analysis notifications. Let's start with the core idea of smart money concepts, or SMC. Retail traders usually react to price after it has already moved, often chasing the green or red candles. Smart money concepts works differently. Large institutional orders are too big to fill at a single price point. Because of this, they leave visible footprints on the chart. We look for two specific things: an origin point, which we call the order block, and a gap left behind by the extreme speed of a move, known as the fair value gap. This strategy is about identifying those footprints and trading the return to them. We aren't looking to catch the first impulsive move. We are looking to enter when the price comes back to mitigate those institutional orders. By the end of this scene, you should understand that our primary goal is to identify where smart money has entered the market and wait for price to return to those levels. Now, let's define our first major footprint, the order block. An order block is the last opposing candle before a strong, impulsive move in the opposite direction. Think of it as the last pocket of orders from the losing side before institutions stepped in and completely overwhelmed them. It is essentially an area of supply or demand that has been validated by a massive price expansion. A bullish order block is the very last bearish or red candle that occurred right before a sharp rally upwards. Conversely, a bearish order block is the last bullish or green candle that appeared before a sharp decline or crash. Why does this specific candle matter? That candle marks the exact zone where large buy-or-sell orders were absorbed. Institutions often haven't finished filling their full position size during that first initial move, because the volume is so high. Therefore, price frequently returns to mitigate or retest that zone to pick up the remaining orders before continuing in the original direction. By the end of this section, you will be able to define an order block and explain why price tends to return to it. Let's walk through how to identify an order block on your chart, step by step. First, scan for a strong, fast, impulsive move. Look for several large-bodied candles moving in one direction with very little to no pullback. Once you find that move, walk your eyes backward to the very start of it. Find the last candle of the opposite color right before that explosive expansion began. Now, mark the high and the low of that single candle. This becomes your order block zone. Notice that we use a box, not just a single line, because the entire range of that candle represents the institutional interest. Finally, we wait. We wait for price to return into that box on a lower time frame before we even consider an entry. A common mistake is marking every red candle before a green candle as an order block. This is wrong. Only the move immediately following the candle counts if it is genuinely impulsive. We want to see strong bodies, an expanding range, and often a visible increase in volume. A slow grind upward does not qualify. You now have a clear checklist to identify high-quality order blocks. Next, let's explore our second footprint, the fair value gap, or FVG. An FVG is an imbalance in price left behind when a move is so fast that buyers and sellers didn't fully transact at every level. Visually, this appears as a gap between the wicks of three consecutive candles. While an order block represents absorption, the FVG represents a lack of liquidity, a hole in the market that the price often feels compelled to revisit. How to identify an FVG? First, look at three consecutive candles. Then, compare the high of candle 1 to the low of candle 3. To identify a bullish FVG, look at three consecutive candles during an impulsive move. Compare the high of candle 1 to the low of candle 3. If the low of candle 3 is higher than the high of candle 1, there is a gap between them that candle 2 jumped over. That untouched price zone is your fair value gap. For a bearish FVG in a downward move, use the mirror logic. Compare the low of candle 1 to the high of candle 3. If the high of candle 3 is lower than the low of candle 1, you have identified a bearish imbalance. By the end of this scene, you should be able to spot these 3 candle patterns and mark the resulting imbalance zones on your chart. Why does the fair value gap matter so much to us as traders? Price has a strong statistical tendency to return and fill this gap before continuing in its main direction. Think of it like a stretched rubber band. When the market moves too fast, it creates a vacuum. The market usually snaps back partially to fill that undertraded zone before resuming the trend. While it is not a 100% guarantee, it is a well-documented tendency used by institutional players. Now, let's talk about the real magic. Part 3. Combining them. An order block alone is a decent zone. A fair value gap alone is also a decent zone. But when an FVG sits inside or right at the edge of an order block, we have found something special. This is what we call real confluence. These are 2 independent institutional footprints agreeing on the same small price area. They are powerful together because they come from different mechanics. The order block represents the absorption of orders, while the fair value gap represents a liquidity imbalance. When they overlap, the probability of a successful trade entry increases significantly. By the end of this scene, you should understand why the overlap of these 2 concepts creates a high probability point of interest. To turn these concepts into a profitable strategy, we must follow a strict set of base trade rules. Trading without rules is just gambling. Our first rule is the bias filter. Only take the setup in the direction of your higher time frame trend, such as the daily or 1-hour chart. This ensures you are trading with the overall momentum, not against it. Next is the entry trigger. Wait for price to return into the order block zone and the FVG within it. We look for a rejection candle, like a long wicked pin bar or an engulfing candle, to confirm that the smart money is indeed defending that level. For your stop loss, place it just beyond the far edge of the order block. This is our structural boundary. If price closes through this block, the setup is invalidated. Target 1 should be the high or low of the original impulsive move that created the footprints. Target 2 can be the next major structure level or liquidity pool, like equal highs or lows. Finally, invalidation. If price closes through the order block, not just a quick wick, but a full candle body close, the zone is broken. You must exit or not enter the trade. By the end of this scene, you should have a clear framework for when to enter and exit a trade based on these institutional zones. Now, let's take your analysis to the next level. We are going to strengthen our price action setup using open interest, or OI, walls. Order blocks and fair value gaps are drawn from price alone. Open interest is different. It is drawn from positioning. It represents real capital committed at specific strike prices in the options market. Combining these 2 means you are checking whether the chart-based zone you found is also a zone where large option writers have already staked capital to defend. This is one of the few genuinely independent confluence layers you can add to SMC, because OI comes from the derivatives market, not from the price action itself. A call OI wall near your bearish order block zone means option sellers are already positioned to defend that ceiling. This reinforces why price may reject there again. A put OI wall near your bullish order block zone means option sellers are positioned to defend that floor, reinforcing why price may bounce there. If your zone has no meaningful OI nearby, treat the setup as lower conviction. There is less capital actively defending that price, making it more likely to be swept through. By the end of this scene, you will understand how to use the options chain to provide a second opinion on your technical zones. Let's summarize our strategy into a 3-layer confluence checklist. This is how you transform from a reactive trader to a professional analyst. Layer 1 is the order block. It confirms where large orders were absorbed, sourced from price action and candles. Layer 2 is the fair value gap. This shows where price is statistically likely to return to due to imbalance. also based on price action. Finally, layer 3 is the open interest wall. It confirms if real capital is defending that zone, using data from the option chain. The rule is simple. Take the trade only when all 3 layers point to the same small price zone. If you only have 2 out of 3, treat it as a watch list setup, not an entry. To build this into your process, first, mark your order block and FVG zone on the chart. Second, open the option chain or OI bar graph for the nearest expiry. Check whether a large call or put OI cluster sits at or very near that same price zone. If it lines up, it's a high conviction setup. You can tighten your stop slightly and consider standard risk. If OI is building away, treat that further wall as your first target, as price is likely to be pulled there. Always recheck your data. OI shifts throughout the week, and a wall from 2 days ago might be gone today. By the end of this scene, you should be able to integrate open interest data into your technical chart analysis to identify the highest conviction trades. To truly master this strategy, let's walk through a detailed worked example using real-world numbers from the Nifty index. First, we establish our higher timeframe bias. Assume Nifty is in a clear uptrend on the daily chart. Our bias is bullish, so we are only looking for buy setups. On the 15-minute chart, we see Nifty rally sharply from 24,200 to 24,450 in a handful of large green candles. Walking back, we find the last red candle before that rally was at 24,190 to 24,210. This is our bullish order block. Within the first 3 candles of the move, candle 1's high was 24,220 and candle 3's low was 24,260. The gap between them is the fair value gap. Checking the option chain for the nearest expiry, we see a large put OI wall sits at 24,200. This is our third confirming layer, sitting almost exactly inside our price zone. All 3 layers agree. This is a high conviction trade worth acting on. By the end of this example, you should see how price action and derivatives data work together to create a professional trade plan. While we look for high probability setups, we must remain grounded in reality. Let's discuss Part 7, the honest failure case. Not every order block and fair value gap zone holds, even when supported by open interest. A professional trader expects losses and manages them. Watch this example. Price returns to our zone, but instead of bouncing, it closes clean through it. This invalidates the setup immediately. This typically happens for a few reasons. First, the original move might not have been driven by institutional absorption. It could have been a low-volume move or a news-driven spike that lacked real commitment. Second, the higher time-frame trend might have already started shifting before the retest occurred. Always respect your stop loss and the invalidation rule from Part 4. Never hope the zone will hold if the price is already closed through it. Finally, a vital disclaimer. This lesson is for educational purposes only and is not investment advice. Order blocks, fair value gaps, and open interest analysis do not guarantee outcomes. Every trade carries the risk of loss. Size every position according to a fixed risk rule, such as risking only 1% of your capital per trade. Please consult a SEBI-registered financial advisor before making investment decisions. By the end of this scene, you should understand that risk management is the most important part of any strategy. To wrap up today's lesson, let's look at how all these elements come together on a real trading interface. When you use a platform like Dhan, you can see these price action footprints and the open interest data simultaneously. This speed of analysis is what allows professional traders to catch moves that others miss. Remember our core philosophy: we don't chase price. We identify where the smart money has left its mark, and we wait patiently for the price to return to that value. Take some time today to open your charts and look for these patterns. Scan for those impulsive moves, walk back to find the order block, and check if a fair value gap was left behind. Then, look at the options chain to see if the OI supports your zone. If you found this breakdown helpful, make sure to like and subscribe to Index Orbit for more deep dives into institutional trading strategies and daily market analysis. To start practicing with live data and quick trade execution, use the link in the description to open your Dhan account with referral code EJZZI96380. Trading is a journey of discipline and constant learning. Master these footprints, respect your risk, and I will see you in the next analysis.